advisor and a board member of several organizations. We welcome you, sir, to the panel. Now, second panelist is Mr. Anil Talreja. He is a partner at Deloitte India, specializing in M&A tax with over 28 years of experience in Indian tax and regulatory matters. He serves as the Chief Growth Officer for Tax in Deloitte South Asia region and has international experience from his tenure with Deloitte UK's M&A tax team. Mr. Talreja is also a chartered accountant and holds a master's degree in commerce. We welcome you, sir, to the panel.
Next, we have with us Mr. Abdullah Petiwala. He's a seasoned tax and finance professional with over 25 years of experience across diverse industries. A chartered accountant and an associate certified coach, he has successfully led GST implementation and advised industry leaders on complex tax matters. As head of tax at HDFC, he specializes in tax risk management, compliance, and litigation. We welcome you, sir. Moving forward to Mrs. Gaura Sengupta, who is the Chief Economist at IDFC First Bank, specializing in macroeconomic analysis and monetary policy. She provides insights on inflation trends and the Reserve Bank of India's policy outlook. Her analyses are featured in the publications like Money Control and the Economic Times. We welcome you, ma'am. Next, we have with us our moderator, Mr. Tamal Bandopadhyay. He is one of India's most respected business journalists, known for his insightful column, Bankers Trust. With over 2 decades of experience, he has closely tracked the evolution of Indian banking and finance. An award-winning author, he has written 7 best-selling books on banking, policy, and financial institutions. Currently, he is a consulting editor at Business Standards and a senior advisor at Jenna Small Finance Bank. We now hand it over to you, sir.
Thank you. I am Shillong, and welcome to this budget show. And I must say that it's a very well-crafted panel. We have CEA Anand Nageshwaran with us. We have an economist, and we have 2 gentlemen who will give an industry perspective and also, of course, what it means for the global investors and what it means for the corporate India and individuals on the tax issues. So my job is to provoke you and get the best out of you. I remember somebody said that Larry, I think some of you must have heard the gentleman's name, Larry Fontronsky. So he was Elizabeth Taylor's ninth husband by the 8th marriage. So on the after the wedding, the night, one of the fancy ranches, they are spending night, and Fontronsky's challenge was how do I be different from her past 7 husbands. So our challenge also like that. Budget is almost 1 day old, not almost 1 day old, and a lot of things have been written on print media, a lot of discussions on television channel non-stop. So how do we be different from them? So that's the challenge. So let's take it head on. First, I just would like each of you to talk. How do you feel about the budget? And as far as I'm concerned, I reached out to many people yesterday that how do they feel about the budget, and I asked them to tell me in 3 words. So first thing, a lot of interesting stuff. But one person said it's GRF. Now GRF stands for Growth, Reforms, and Fiscal Prudence. Yet another person says, no, it's MMB. What is MMB? MSME, Middle Class, and Bihar. So with this, I end, and let's start with Gaura.
Thank you, sir. Thank you, everyone, for joining. So from an economics perspective, we like it when the budget is fiscally prudent. We do understand the demands that were put on this budget were significant. You had both consumption as well as capex sectors asking for help. And given the restraint, the budget has delivered. They have stuck to fiscal consolidation. They have outdone it. They have reduced the target of fiscal deficit to 4.4% of GDP. And the consolidation that they are planning to achieve is led by revenue expenditure, while the focus on capex has been maintained. So as far as the fiscal bandwidth was there, they have remained supportive to the capex cycle. And obviously, the income tax cut is a welcome move. Though from a macro perspective, the capital expenditure will have much more growth implication than the tax cut. The tax cut is welcome, will be a good move at the margin, given that right now consumption, especially urban consumption, has been reeling under inflation as well as slowing income growth. So this was a welcome move. But what we like about the budget is the fact that it remains fiscally prudent, and whatever space they had, they have allocated it to the capital expenditure front.
Thanks, Gaura. So that's what the economists take. She's attached to a bank. So let's hear Anil, tax and everything else. Anil is from the HDFC Group.
That's Abdullah.
Oh, sorry, Anil, you're Deloitte. I'm sorry, it just got to because my page just entered my room and I got distracted. So Anil is from Deloitte. Sorry. Yeah, please.
No, thank you. We are anyway in the same fraternity. So, the way I call this budget, I call it BCT. B as in bold, C is confidence, and T is for trust. Bold because of the fact that given where we are in our global economic challenges stroke uncertainties, I think full marks to the government and the finance minister to come up with a budget to actually almost wave off, as she announced, 1 lakh crore worth of taxes on the personal front. Why do I say confident? Is because I think from our investor community, from the foreign FDI perspective, we have witnessed in the last few months that FDI has increased by almost 42% year on year. And just before the budget, we were all very anxious and keeping our fingers crossed that this momentum of increase should continue. And as we see the budget, I'm very confident that we will continue to be the most attractive market for foreign investors. We will continue to be one of the highest consumption market for the global world, and it's a budget which is clearly articulated the fact that there is a lot for foreign investors to earn when they would invest in India. Just to double click on this aspect further, and we can talk about it a bit more later, there has been an overall sort of policy announcement starting from MSME, as you said, to manufacturing. So the aspiration of India becoming a global manufacturing hub has been articulated very, very nicely in the budget, which again indicates, that the Indian markets are open for foreign investors to come here and invest in India and also gain out of the investments, not just invest. So that's on, I think, the confidence part. There are lots of other parts which maybe I'll bring it out later. And T stands for trust. I think one of the challenges that traditionally we've always had is to gain the trust of the people at large. The finance minister made a very clear mention that her objective was to increase the level of trust. So some of the provisions or announcements that she has made, which I'm sure Abdullah will add on from the tax side, clearly indicate that they are very, very keen to increase the trust levels of the various taxpayers, people of India, rather than getting into more of a investigative mode. They would like the people of India to trust the government, and this is where they have evidence by virtue of the budget policy announcement. So BCT is what I would sort of put the budget in, and hand it over back to you, Tamal.
Yeah, thanks, Anil. We'll get into the micro issues later. Anand, I'm keeping you as the last speaker because you are the star. You are the star attraction. So before that, Abdullah, just give your stake and my apology for that confusion. As I said, I got just distracted. My pet walked in, and that's what I told Anil from HDFC.
No,
Abdullah from the
absolutely
HDFC.
no issue.
Please, Abdullah.
Okay, so from a tax perspective, I would say it is a good budget. Okay, except there is one thing which very few people are talking about, and that would be I would say a little a black spot on the budget. is one retrospective. It's a little fine print, but it's a retrospective amendment which effectively went ahead and reversed the Supreme Court judgment, which was a wonderful case which was taken till the Supreme Court level on whether the input tax credit is available for plant or machinery. The way the amendment which has been done in that is saying it overrides any judgment, decree of any court whatsoever, or anything pending, and the tax credits would not be available. Now, considering that somebody went all the way through and won at all levels up to the Supreme Court, I think the Safari Retreat judgment should not have been retrospectively overruled. They could have done it on a prospective basis. Somebody found a little loophole on or an and being used in a certain provision and had won correctly. That being said, the very good thing about the budget after many, many years is finally the salaried taxpayer will get some money on hand. Okay, I mean, 1,10,000 is a substantial amount, irrespective of how much you earn. I mean, 1,10,000 is still 1,10,000 on hand. Till now, generally, the budget used to give you a few thousands here and there and take them away from, like last year it was done. Some money was given and the capital gain tax was increased and so on and so forth. Net, nothing was in hand. This is, I would say, after a very, very long time, from a tax perspective, something is left on hand to spend. And I think probably that is as... like Gora said earlier, probably, it would help sort of at least like initiate consumption. And therefore, again, of course, if the consumption increases, there's the 18% tax the government earns. But yeah, I mean, at least there is some money on hand to spend, even though paying that 18% out of that back to the government. So overall, I would say a good budget, except this one thing which really is not in line with the policy of the government, since this government, was generally opposed to retrospective amendments and, respecting the judiciary. So to that extent, yeah.
Thanks, Abdullah, for being so candid. So till now, Anil is all praise for the budget. Everything is correct. Abdullah has found actually one gap somewhere, and Gaura spoke about it's basically expenditure curtail. Is the right way of doing it. So over to you, Anand. Just before that, Anand, just one line about your economic survey. One particular line, I think para 10, get out of the way of business. That hit the headline everywhere. In some places out of context, in some places explaining the context. So take off from there. I mean, does the budget show that yes, government, both center and state, actually they are getting out of the way of business?
Thank you, Tamal, and very good morning to all my fellow panelists. And before I respond to Tamal's request or edict, if I may say so, I would like to acknowledge Mr. Abdullah's point about the one retrospective amendment that he saw, and I will take it up with my colleagues. Thank you very much for pointing that out. Yes, I think the budget does follow through on that particular paragraph, as you put it. And Tamal, thanks for pointing out that it wasn't a message sent to one particular entity in the government system. It was sent to the government system in the country, state, local, union, etc. And I think the Honorable Finance Minister in her budget speech did refer to the importance of trust in several places in her speech as well. And some of the measures announced, more importantly, the high-level committee on deregulation has been announced in the budget, and that will go into all non-financial sectors. And it also specifically mentions working with the state governments at their level as well. That is a very direct follow-through in the budget on the key aspect mentioned in the economic survey. The second thing the budget also does is, in some sectors, of course, the regulatory overreach is something that has been voiced by industry participants in several areas, and this one hasn't gotten the attention that it probably should have. And one of the paragraphs in the budget speech refers to the FSDC Council being used as a forum to give a little bit of a more scrutiny or impact assessment of regulatory policies pursued by the financial sector regulators as well. So in that sense, the key premise of the economic survey, which is about giving households and businesses their time and mental bandwidth back so that economic activity can proceed unhindered. That has been taken on board very seriously. And then also in some of the smaller measures in terms of procedures and compliance, and more importantly, the new income tax bill that is going to be tabled in the parliament next week, and giving people doubling the time given to assessees to go back on that assessment for up to 4 years compared to 2 years earlier. All these things are in line with the message that came out in the survey. But since my other fellow panelists have been more disciplined with their time, I will also stop here, Tamal, and the rest of the questions can be taken up based on the discussion. Back to you. Thank you.
Thanks, Anand. We'll go the reverse way now. Anand, you'll be the first speaker in this round. And before that, those who are watching it, if you have any specific question, please do get in touch with the organizers, send your name and what you do and your question and to whom it is addressed. I will take this question. So Anand, this is your actually cup of tea. That's what I want you to throw some light, because our audience is the IIM Shillong students. Now, growth is one aspect, but probably even more important for many of us is that the sticking to the fiscal consolidation path. Right, 4.9 was the target. Actually, is achieved even less. Better 4.8, and now we are going for 2026 4.4. And even more interesting part is this: now the government is going to the new path of fiscal, looking at the fiscal deficit, following the FRBM mandate, which is the debt to GDP ratio 50% plus minus 1 percentage point by between 2027 and 2031, right? And this fiscal deficit will be derived from that. As an economist and also as the CA, Chief Economic Advisor to the government, can you explain to us what does it mean, and everything else, what do you think? Just right from fiscal deficit as a percentage of GDP to the new way.
Thank you, Tamal. I think this
For
was...
the students, it will be very interesting to know.
Thank you, Tamal. This was flagged in the last July budget as well, that the government would strive to bring the fiscal gross public debt at the union government level down by at least a percentage point every year going forward. And this year's budget is giving concrete shape to that statement made in the July 24 budget. In general, it is seldom possible, excepting with very high inflation. It is seldom possible to run a high fiscal deficit and yet bring down the public debt. So in that sense, there should not be any misunderstanding that the emphasis on bringing down public debt will mean that the fiscal deficit prudence or fiscal prudence on an annual basis will be compromised. It is not the case. For a vast majority of situations, both public debt and fiscal deficit management are two sides of the same coin. But what this one does, and India will not be running inflationary policy both on the fiscal and the monetary front, since from 2015 onwards, we have an inflation targeting framework as well, which circumscribes the levels with which inflation can rise in the country. So therefore, there should not be any concern that the articulation of fiscal prudence via a reduction in the debt to GDP ratio means a dilution in the fiscal commitment of the government. And secondly, I would also like to tell my dear students that the proof of the pudding has to be in the eating. And as Tamal pointed out in the beginning of in his initial remarks, or maybe it was Gaurav who said that, when pandemic happened, the union government's fiscal deficit was 9.2% of GDP. And when the government made the promise at that time that it will be brought down to 4.5% or less by FY26, there were very few takers for that promise. We always thought that in keeping in line with the historical record of governments in the last 20, 30, or maybe 40 years, when the time comes, there will be excuses trotted out as to why that number could not be met. But what the Honorable Finance Minister did year after year in the last 5, 6 years has been to plan her nominal GDP growth and revenue growth realistically and ensure that this was delivered. And for FY26, it is 4.4%. And I'm grateful to hear from the rest of the panelists that the 4.4% isn't an unrealistic target given the assumptions made for nominal GDP growth and also the tax buoyancy assumed with respect to direct and indirect taxes. So that should be kept in mind. But why is therefore this focus on debt? I think debt encompasses deficit in almost all situations, excepting in a very high inflation state, which we saw in the early part of the last decade. You could run a high fiscal deficit and bring down the debt to GDP ratio if you have a double-digit inflation rate for almost 5 consecutive years. So that is a situation that is not going to happen. But having a debt criteria gives you more flexibility to deal with the situation as it emerges. And that is exactly the context that the economic survey paints, which is that the global economic and political environment is beset with uncertainties. In fact, as we gather today to discuss in this panel, we are hearing news reports coming out that tariffs have been imposed on Canada and Mexico, and also some of it is on China as well. I haven't read the White House readout on this or the press release. But this is an example of multitudinal uncertainties that we are facing. And it is important, therefore, to have a certain credibility in the fiscal process, not to bind oneself too tightly with commitments and then later on coming up with the reasons as to why those commitments could not be honored. But it is rather in keeping with the practice over the last 5 years of under-promising and over-delivering that this instrument has been chosen to signal the government's commitment to fiscal prudence. Thank you. Back to you, Tamal.
Thanks, Anant. Yes, you are correct that Trump already announced the tariff war. But just one follow-up thing quickly, you can say that globally, because you worked in different geographies also, this between the GDP as a percentage of GDP and the new formula which will be trading from the next year onwards, that data as a percentage of debt to GDP ratio. Globally, what is the way of doing it, country-wise?
What is the point?
I said globally, some of the developed markets, what do they follow?
Oh, I think, we all know in the 1990s that the European Union came up with a number for fiscal public debt convergence in the states that were trying to become members of the European Monetary Union, Economic Monetary Union, and they pegged the number at 60%. Some of it was calculated, some of it was almost a pie in the sky kind of number, given the various extremely high levels of public debt that several countries carried. And even now, based on that particular criteria derived in a meeting in Maastricht in the Netherlands, in general, the world over has accepted that 60% of GDP is the gross public debt of a government that all governments should aspire to hit or lower, and fiscal deficit being 3% of GDP. It's partly calculated and partly more of a random choice, because there isn't any systematic empirical evidence that countries that have a fiscal deficit higher than 60% of GDP have suffered a macroeconomic performance deterioration. So, and globally today, as you correctly pointed out, Tamal, many advanced economies have not only not brought down their public debt ratio, but in the last several years, starting from the global financial crisis of 2008, And then following up from the pandemic as well, haven't made any attempt at all to reduce their public debt to GDP ratio. But if anything, those ratios have continued to climb even 3-4 years after the pandemic has ended. So in comparison to several other countries, advanced or developing, this government has been sticking to the path of fiscal prudence, promising and delivering on it. And that is just to give you the global context. Back to you, Tamal.
Thanks, Anand. There, I think US is a classic example. It doesn't care, right? Okay. I wanted to talk to Abdullah. Is back? Yes, Abdullah. So tax is all your domain. Just tell us that new income tax bill which will be placed in Parliament tomorrow, right? What are the expectations?
Yeah, well, the new income tax bill, probably, I mean, the way I look at it would effectively be hopefully something in line with the direct tax code that was placed a few decades earlier. Okay. It hopefully would be a little more simplistic in reading. Okay, whilst, yeah, over the last 30 years, I have read the old act and you're quite familiar, but hopefully, the new act would have a more simple language, more lucid to understand. And the learnings from the GST law would be taken and not repeated. Because the GST law, of course, I mean, it's been 7 years now, but it's still developing. There's still, the number of notification circulars that come on a daily basis do make it a little cumbersome in the way. Whilst, yeah, overall, the implementation has been very good. But from a person who does tax, having some changes on, day-to-day basis becomes a little of a problem. And more from the tax administration point of view, like of course, as an individual taxpayer, it does not matter much. But when you look from a corporate point of view and the tax officers and the assessments and the notices which happen, it helps to have, a stable law at least for a period of 6 months to a year, rather than the clarifications coming in every now and then, and the interpretations changing, the tax officers then applying that, I mean, from day one, and so on and so forth. So, I mean, with the changes that have been proposed and the ease of doing business being the main like theme in many of the amendments which were done, as well as reducing the tax burden. Okay, I think that would be carried forward in the new bill which is proposed to be put up next week. So
yeah, thanks, Abdullah. But
to a very good thing.
Abdullah, you provoked me. Can you just tell us in a minute or so, 2 minutes and all, that GST, that confusion, 7 years later, even still grappling with a lot of challenges. And I don't want to repeat the popcorn controversy a couple of months back, what happened and all. So tell me, what needs to be done to streamline the GST issue? Is it the state versus center, or is it we are total confusion? What?
No, okay. So what happens is many a times when we started, let's say in 2017, 2018, some reliefs were given, right? Up to, I think, 2020, I mean, I would say 22 onwards is wherein things had stabilized, and, we also knew what used to, like what needs to be done, as well as the officers then knew, okay, this is how they need to look at stuff. But being in 2022 and trying to apply those principles to what was submitted in 2017 and 19 does create a lot of issues, because certain things which now you are supposed to maintain from 22 onwards, the officer basically needs that same hygiene to be applied for the past years, which as industry, and I am saying across the board, all industries, does become very difficult.
Okay. Anil, over to you. Tell us, when Gaga were everything that it will open up new investment, FDI will continue, FII will come, FPI will be there, everything is there. Just can you point out what are the measures that make you so excited about it?
Sure. No, so there are a few things.
Consumption, growth, that we all know. But what are the specific thing that would attract foreign investors, both in the portfolio segment as well as the other way? What are the lollipops there?
So I think the few things here. I think, as I mentioned earlier, I think the finance ministers realize that for whatever reasons historically, the confidence was of the investors was slightly less, and the objective over here is to bring that back. I mean, the new direct tax code or the new income tax bill, decriminalization of various regulations, talk about a fund of fund which has been now constituted, whereby they will be making fresh investments in specific sectors. One of the things that has been clearly articulated in the finance bill is there is focus on a wide range of sectors. So I'll give a few examples. For example, the medical sector, textiles, electronics. And electronics has been given a massive boost in terms of rationalization of customs duty, as well as incentivizing people to make investments in that sector. So electronics is a big one. Energy and power, green energy. Again, we've seen announcements in that aspect. So I think the point I'm trying to make, seafood, again, aircrafts and railways. There have been super announcements made to incentivize investors to invest in these sectors. And these announcements are more in the form of, it's twofold. One is rationalization of customs duty, whereby if you see the Prime Minister's vision of Make in India, it is now being taken to another level by ensuring that that is a dream come true. Uh, Rationalizing customs duty, bringing about various policies like the fund of funds, ensuring that from the farm to fork, so agriculture has been still very very important because it is a substantial part of our economy. From a foreign investor point of view or any financial investor point of view, I think these are measures which clearly give a message that India has been on a growth trajectory. India promises to be on the growth trajectory going forward. And it's not that we are seeing turbulence in our economy, which is a very, very strong, loud message. One would have expected, when we speak to a lot of our overseas clients, one would have expected that, people would have said that, we don't know what's the international economic scenario. There's a geopolitical connection to this. We've had a new leader in the US. The UK came up with changes in uh, domiciliation laws just last week. So how is that going to have an impact on India? I think India is on a roll. The message from the finance minister is that, look, all these things will continue to happen. We have the benefit of being a large market, and we will capitalize on that. One other point that I'd like to mention, the way the government has played out on investment, they have encouraged domestic investments. So the fund of fund, or a few examples that they've given, they've said we would like domestic investors to make investments in India. What is the message that is being given? The message is we're not completely dependent on foreign investments. We're saying that here is where the domestic investors will invest. And now it's a very healthy competition between domestic investors and foreign investors. So, it's like, when you have to really put down a pen to paper and say, here is where the areas are where I will have Indian headquartered companies prosper. It is also giving a message to investors saying, okay, they're anyway going to put money into the bucket. Why don't I also put money in the bucket? Because it will be a return for both of us. So the message is that uh, uh, simplification of the law. There's been a very significant announcement which I'd like to call out, which is an extension of the tax exemption to the sovereign funds. Now, they realize that sovereign funds have invested in India. There was a window that was getting shut. And I can tell you, we've done some analysis on this. We believe that the extension of the exemption to sovereign funds will bring in at least 30 to 35 billion dollars of foreign investments from these funds. That's our sort of analysis that we've carried out. So all in all, I think it's a very good combination of the Make in India, encouraging Indian manufacturers, at the same time Indian investors, because there is money in India. In fact, with the 12 lakh exemption and the personal tax benefits, there is more money left in the hands of the Indian taxpayer now to make investments into India, and that gives a message to the foreign investors to co-invest in the India story. So that's how I think I would look at in terms of the reforms.
Thanks, Anil. So it's not that any direct certain benefits being offered, but it's strengthened the India story that we have been writing or rewriting. That's what you're saying. The Viksit Bharat story. Thank you, Gaura. Thanks for your patiently waiting. So, being an economist, I would repeat the same thing. If you can just tell us a little more about what Anand said about the track change from the way to look at our fiscal deficit. How do you, sitting in your chair, how do you see that? And the other part is this: you yourself raised that this revenue expenditure compression. Revenue, it's but whether it's a ideal thing to do, because as an economist, you know that expenditure multipliers are much higher than the tax multiplier. Right? If I'm not mistaken, I'm not a student of economics, but that's what I learned. So on this too, can you, because our audience is the students, IIM students, let them understand an economics take.
Thank you. So, starting with the debt to GDP framework, the good part about that framework is that right now what we are doing is we are mechanically targeting this much reduction in fiscal deficit to GDP. So, we are, let's say, targeting a 0.4% reduction. What the debt to GDP does, it takes into account how the debt stock evolves as a ratio of GDP. So you have the flexibility to go for a smaller incremental reduction in fiscal deficit as long as the trajectory over a period of time is going down. Because as a emerging market, we have a there is a lot of pressure on us as an economy to get our government debt to GDP lower. And as you earlier mentioned, the US, they have the full freedom to go, and their debt to GDP, especially the government debt to GDP, is on an exponential track. But them being an emerging currency, they get that flexibility. But for us, the pressure is enormous that every single year the government has to reduce the fiscal burden, basically. So what this framework does is that over a period of time from FY 27 to FY 31, it gives you the flexibility that they can slow down the pace of consolidation, because we are an emerging market. The budget also has to be growth supportive. For example, during COVID crisis, developed countries gave enormous fiscal stimulus. For example, you see the US, they gave 25% of GDP fiscal stimulus. India remained very conservative, and again, we were forced to because we're an emerging market. So we worked within our own restraint and gave a fiscal stimulus which we could afford to. So this framework enables us that going forward, more space opens up to support growth as the pace of fiscal consolidation can be slowed. In terms of your second question of, so as per our calculations, to get to that 50% central government deficit debt by FY 31 from 56% currently, you need to keep your fiscal deficit somewhere between 4 to 4.3% of GDP over this time frame. So it's a much more moderated pace of consolidation, and you still achieve with a 10.5 nominal GDP growth rate, a gradual reduction in your government debt to GDP. The second question on the reduction in revenue expenditure. Yes, from a growth perspective, revenue expenditures is important. It goes into government services, which is captured within the GVA. But more than revenue expenditure, it's always better the capital expenditure can be enhanced. And this budget, whatever space they had within the constraints that they have to operate, They delivered. They reinstated the capex target at 11.2 trillion, slightly higher than the target for FY25. There is a limitation of how much capital expenditure that a government can execute in a year. So again, realistic target, an implementable target, and it's good because even though as a proportion of GDP, your capital expenditure is constant at around 3.4%, but the growth rate has picked up compared to FY25. So incrementally, it's good. The compression that they have achieved on the revenue expenditure, it's spread across. So there's a slight more moderation growth rate, let's say, in certain items such as pensions, etc. But it's not, it is spread over items. So in terms of growth impact, we don't see it as a negative or a sort of a drain on growth. The good part is that they maintain the focus on capex. And currently at this juncture, if you look at what's happening at the state government level, where the focus is shifting more towards revenue over capex. The center has demonstrated by the union budget the focus on capex, and they have actually curtailed the revenue expenditure side, which is actually a very good when you see what's happening at the state government level.
Yeah, thanks, Gaura. This capex is 11.2 trillion this year, and meaning the coming fiscal. And the last year it was announced was 11.11, but it's been toned down by 1 trillion. It's been cut, the revised estimate. So anyway, from now on, let me ask some general questions, and each of you can give an answer. And before that, I repeat what I had said to the audience. If you have any question, please do send it to the organizers. Now, this one is little technical, but definitely Anant and Gaura, you will enjoy it. But Abdullah and Anil, you will also think if you can answer. Because I have been reading and I have been watching people there and all this about the tax exemption. Now, everybody is going gaga over it, and there's the right thing to be done, the middle class up to 12 lakh and all. But this, globally, I am told this tax exemption comes actually that are depending on the per capita income. Now, looking at India's per capita income, this 12 lakh is 5.5 to 6 times higher. Now, is this the right thing to do? I mean, I saw one economist on television channel. He was blasting that this should not have been done that. And this is probably the highest in South Asia that we have done. Is it the right thing to do? Anant was nodding. Probably you answer, and then Gaura and others. There's no correlation between per capita income and the exemption that you have given. It's a 5.5 to 6 times.
So, sorry, I think there is campaigning vehicles going on the road.
But
Sorry
we can't
about-
hear anything. Huh? Your ambient
Okay.
sound, we are not getting anything. So fine. As long as you can hear us, it's fine.
So I think Tamal, it is a point that is obvious to anybody who looks at the data that you have a per capita income of around 2.2 to 2.3 lakh rupees per annum, and the no tax threshold is now available up to 12 lakhs of rupees of annual income for individuals. It is close to about 5.5 times or something like that, and it is higher. But equally, and this has been there. I mean, this has been there for a long time to come. That India's no tax threshold runs up to orders of magnitude compared to the per capita income. It has been the case for a few decades. I mean, if not even longer. So that is nothing. There's nothing new there. Maybe the magnitude has expanded with this exemption given. That said, India also had the other distinction of going from the level at which taxation starts kicking in to one of the maximum marginal tax rate within an extremely narrow band. Now you can go and look at the examples that people have cited, whether it is emerging or developed economies, from the level at which they start taxing their income, which I agree is well below the per capita incomes in several countries, and the level at which the maximum marginal tax rate applies, that multiple is of the order of magnitude of 20 to 40 times in several cases. Just give you one example. Take Singapore. The per capita income is around $80,000, roughly speaking. And the lowest tax threshold starts at $20,000. Okay. which means people earning income about $20,000 per annum start paying an income tax of 2%, about 20,000. Up to 20,000, it's a no tax. But then the maximum marginal tax rate of 22 or 23%, I am not fully familiar whether it is 22 or 24 these days, whatever it is, that number, that rate kicks in at an income above $320,000 per annum. That is a 16 times increase. Whereas in India, we began at up to 7 lakh was no tax. And suddenly, by the time you hit 15 lakhs, you have to pay 30% marginal tax rate. So this anomaly also was there. So, but the fact that we are not able, we cannot go back and address the other feature, which is that the minimum tax threshold starts at a high multiple of per capita income, doesn't mean that we should not fix another anomaly, because two wrongs cannot compensate each other. So we have addressed one of this component, but hopefully what will happen is, if this is able to rejuvenate economic growth, then the faster pickup in per capita income will reduce this gap between the minimum tax threshold and the per capita income. Back to you.
Is it, Anand, is it putting the cart before the horse kind of stuff you are saying? And Anand is muted.
No, I wouldn't say it is putting the cart before the horse. As I said, I mean, this has to be this is also an important distortion that needed to be fixed, because we were moving towards the highest marginal tax slab at a very, very narrow band between the first tax threshold and the maximum possible tax threshold. So I think we have to start somewhere when it comes to economic policy making, and some of the decisions moving towards, you cannot today say, okay, we will start taxing at 60,000 rupees per annum, because that is what other countries are doing. We have to be mindful of the Indian context and move to address one part of the challenge. And hopefully that it in turn will kick off a certain series of economic outcomes, which will also help us address the other anomaly reasonably quickly. I would interpret it that way than the way in which you characterized it, Tamal. Back to you.
Thank you. Any of you, Anil, Abdullah, Gaura, any of you want to speak on this? Yeah, Abdullah.
Yeah. So, I mean, it's actually an interesting thing that you said the minimum threshold going up to 12 lakhs. I think one needs to look also from the number of taxpayers in the country. If we look at a percentage of taxpayers in the country, I think that's quite a low percentage. Okay. So, considering probably, 2 to 3% of the taxpayers are there in India, and considering that the individual taxation is effectively more a burden on the salaried taxpayers than on any other taxpayer, whilst the rates may be there, etc. Because for professionals, business income, there are business expenditures, etc. The one part in the overall direct tax law that is salary from, income from salary part has effectively, since it was introduced, okay, and thankfully, of course, there are a couple of changes in that which have come in, because the earlier threshold which were there of 20,000, 24,000, 50,000 rupees, which were there during a year, anything about that was to be considered as perquisite, etc. Now at least are proposed to be revised and brought up to standards. So the last amendment which was done in one of the provisions was somewhere in 2001. I mean, considering that it's almost been like more than 2 decades, and nobody saw that provision and thought of updating the minimum thresholds out there.
Thanks.
So I think it is a very positive thing to actually have a higher threshold. And of course, as Ananta said, the gap from the minimum tax rate, which of course is at 5%, to the 30% that we do, it's the amount is not that large.
Thanks.
If you look at it.
Anil, Gaura, any of you want to? Gaura, you raised your hand quickly.
Yeah, so I agree with the points that are raised. So for example, because our ability to capture or collect direct tax, especially tax from the salaried individual, is much better than capturing, let's say, tax on business income and other forms of income. So the salaried class is actually getting basically squeezed. You have rising cost of living. You have tax deducted at source. You're easily captured in the tax net, and the burden of collection tends to fall on this one particular class. So this particular budget addressed that issue and gave relief to the compliant taxpayer, and it's a good measure. It will also help expand the tax net, will make it less burdensome, for people to enter the tax net because of the lower taxes. It's simpler. You don't have to give proofs, investment proofs, etc. Everything has been done away with in the new income tax regime, so compliance is much more easy. And also the because we are able to capture direct taxes so much better, the dependence of the funding of the fisc is coming more on direct taxes. So direct taxes is contributing 7% of GDP, while indirect taxes, which have a much larger reach because they are like consumption goods, right? Excise, GST, the budget does not have the power to tax, but GST is also another, it covers goods and services that affects all of us. The taxation from there is come down to around 4 to 5% of GDP, just because the burden was getting lifted a lot on the direct income tax, especially. For example, income tax was one of the reasons why in FY25, though corporate tax collections went down, it was the income tax which outperformed and balanced even the shortfall that we got on the corporate tax collection. So it's a good
Thanks,
move.
Gaurav. Yeah. Anil, you wanted to join
I just
some
wanted to make,
quickly.
yeah, one quick point on the point of the threshold of 12 lakh. I think we also have to recognize that the individuals who are below the threshold are also paying taxes, and these taxes is the consumption tax, the
Yes.
GST. So I think that one has to recognize. Otherwise, the sentiment was that we are collecting taxes on GST and income tax both. So it's not that they're completely out of the tax net. I just wanted to make that point.
Correct. Thank you. Thanks, Anil, for this thing. Yes, Anant wants to add something.
No, a very quick one. I think I'm thankful to Mr. Talreja for making that point that yes, it is not that when we talk of taxpayer base, we always look at direct taxes as a metric, but that is not the only one. The second thing I want to also point out, which was a thought triggered by what Mr. Abdullah said, and it is not a response to what he said, but this is a thought triggered by what he said, which is that when the thresholds were initially increased from 2.5 lakhs to 5 and then to 7, the zero tax threshold, there was a fear expressed that the taxpayer base would shrink, but the reality is the data tells you that the taxpayer base expanded. And our approach should be to expand the tax base at the same time by allowing people's income to raise. I think this budget does that. We are not worried, we shouldn't be worried about collecting taxes because the amount of taxes we collect from them is also relatively much lower from the lower income people. So by doing this, if we can create the conditions for macroeconomic growth to do better, and therefore per capita incomes will rise faster, we will have more people earning more than 12 lakhs of rupees. And that is exactly what the attitude should be. And this was just wanted to leave the thought on the table. Back to you, Tamal.
Thanks, Anand. We have 25 minutes left. So before we shift to our yet another round, let's take a few quick questions. One question is from Sonika. Sonika, his question is directed. It's for Anand Nageshwaran. It said that budget, I'm just reading out what she said. Budget mentioned National Manufacturing Mission, Cotton Mission, etc., to boost this sector, but it has struggled to compete globally in the past. And while the government is making new efforts to revive it, what key changes are being made this time to ensure success? Also, with global supply chain shifting and companies looking for alternatives to China, how is India taking advantage of this opportunity?
Quick one, I think.
Very quick. From now on, we just be very brief.
Sure. Okay, so I think we are these missions they have succeeded in the past. That is why our merchandise goods exports, even this year, if we exclude gems and jewelry and petroleum, are growing at close to double-digit rates. I mean, we used to languish at 250 to $300 billion of merchandise exports. Now we are doing $450 billion of merchandise exports every year, and obviously this wouldn't have been possible without the past efforts having borne fruit, and therefore there's no reason to assume that the past efforts have failed. The National Manufacturing Mission will actually build upon the success of the Atmanirbhar Bharat and Make in India programs and also the PLI schemes. The details we will be able to comment on how they will do better than the previous such interventions, and how they will coordinate across different ministries, etc., will become clearer once the terms of reference and the details of those missions are announced. As far as the China plus one is concerned, it is happening, but it is not something we need to be patient. It won't happen that quickly, because moving all the supply chains along with a major manufacturer to a different country, taking into account cultural and labor law differences, etc., will not be that easy. Natural for businesses operating in China to first consider moving to Vietnam, Taiwan, etc., because there are lots of cultural alignment there as well, including language. So I think it is already happening in mobile phone manufacturing. Part of it is happening in pharmaceuticals, in renewable energy space as well. It is gaining traction, but we need to be also mindful that the time frame has to be much longer to evaluate the success than what we have been doing so far. Back to you.
Thanks, Anand. You didn't mention, but the budget also said that we will be the toy capital of the world.
Thank you,
one of the way of
thank you for pointing out.
Yeah, one of the way of competing with China. So there are many more questions, but before that, I don't want to miss out on this one. It's a real sensitive issue rather. I would ask each of you to have 1 minute each. How do you actually encourage and enthuse our corporate sector to invest? Because over the last few years we have been talking about we have been discussing government capex. This time we're talking about growth, consumption, so that corporate India will be forced to invest in new capacity building, etc. But somehow something is missing. Can maybe Gaura, you start, and then each of you want to have 1 minute each something. Anything more needs to be done to enthuse corporate India? What is lacking? Gaura, quickly, 1 minute each, because there are many questions to attend.
Okay, all right. So before I can say what we need to do enthuse, I'll just tell you why it's not coming in. So corporate India is seeing that the demand both on domestic and external front is not very certain. So you're seeing a bit of moderation, urban demand, and externally you have President Trump. So and company will think 2-3 times before investing in capacities. You need to have some certainty on the demand front before you take a long-term investment. So that's what's holding it back. The last time when we had that golden period of 2002, 2007, a lot of things were better. For example, you had a younger global economy. China was growing at 10%. Corporate India profits were growing. So a lot of the corporate India reaction is a function of how they're seeing demand unfold. So incrementally, what can be done? Make sure that the flow of credit, the cost of credit comes down, the flow of credit to certain sectors, which, for example, this budget is also doing, for example, for the credit guarantee for the MSME sector, startup, again, very good initiatives, and shows the flow of credit remains intact. So basically, the government is making sure that there is no hindrance when the appetite for investment does come back, which will be a reaction to demand conditions. There are no policy hindrances, basically.
Thanks, God. But these are all MSMEs and startups. I'm talking about the big bank corporates. Yeah, anybody? Anil wanted to add, Anand wanted to add anything?
Just a couple of quick points.
1 minute.
I think one is the government has encouraged PPPs, which is public-private partnerships, and that is a good way to get private capex into the game. And the second quick point is we always had PPPs, we had state governments signing MOUs, but I think somewhere showcasing what has happened as a result of those PPPs, what are the benefits that have being achieved. I think that demonstration will increase the confidence of the domestic corporates.
Thanks, Anil. Yeah, Anand, want to add anything?
I think the corporates have been investing, except that maybe we were not happy with the pace of investment capital formation. If you look at the data, and we will get the data for FY24 from MOSPI in about a few weeks' time, you will see that the private sector capital formation has been picking up after COVID. Maybe the pace has been a bit slower, but what this budget does is to by boosting spending power and therefore boosting aggregate demand, it gives corporates one of the most important things they keep looking for, the demand visibility, which will make them probably ramp up the pace of investing, which has been happening already. That's my short
Thanks.
response. Back to you.
Thanks. Abdullah, there's a question for you. This question is from student Niharika. She says that with experience advising various industries, what specific tax incentives or reforms in the budget would you recommend which could benefit sectors like real estate, textile, and hospitality, especially as they recover from economic slowdown? Abdullah.
Okay, so I would take it more from the indirect tax point of view, because that is what impacts the corporate the most.
Please.
Wherever the tax credits from the inputs flow seamlessly to the output is the time wherein what happens, the overall cost of production goes down. Okay, or the cost of providing services in case of like construction, etc., that you do. However, there are certain provisions under the GST law which do restrict that flow of credit for certain reasons, maybe economic reasons, maybe because of government policy, or like whatever the reasons could be. So wherever the block of credit happens is the time wherein the cost of production does sort of increase. And especially when there are exemptions. When there are exemptions along with taxable, output for a given company or for a given corporate, that also a percentage of the total common credits does go down. So, while the way our country is there would be a requirement of certain exemptions, there would be a requirement of certain tweaking, and you can't have like 1+1 coming in and, the output goes that way. Because of the uniqueness of a country and the variations that are there in a country basis the states or the regions or whichever way you look at it, they would be at some point of time somewhere wherein all credits can't flow. It's something that we have to live with, and we have been living it over the years. But compared to last 30 years that I look at it, we have evolved a lot under the tax laws that are there as at present. And as we look forward to evolving under the direct tax law also, with less exemptions, with better flow of credits for indirect taxes, and a more simple law, things would drastically improve in the way the corporates having certainty in how much tax has to be paid. That certainty is coming in slowly, is happening, because as the tax laws evolve, there is certainty. So it's a process of evolution for the tax laws.
Yeah, it's a wait for 24 hours only. The new tax law will be in Parliament tomorrow. Okay, so thank you. Anil, there's a question for you. Actually, you dealt with it, but still I'm repeating. It's from Tanmay. The question is, given your work with venture capital and private equity funds, what changes in the budget you would have liked to see to make India a more attractive destination for private equity and venture capital investments?
Yeah, sure. So, there are a few changes that I mentioned. The sovereign fund exemption is a big one. I think there has been some clarity that has been given on Cat 2, Cat 3 AIFs. I think the one important aspect that perhaps we need more sort of fuel, and that is the IFSC and the GIFT City. Now, I know the government has been trying their best to get this really up in the radar with a single window clearance, with benefits from GST, export of services. I think still we find a lot of the investors perhaps a little hesitant to establish their offices in IFSC. One way to sort of deal with this could be to throw a lot of examples. So if you look at, for example, the port city in Sri Lanka, it's a very, very good, attractive way of having a sort of a special zone. China has it. I know the Switzerland has it in terms of cantons. So maybe giving some examples perhaps may help, and coming from the government side, may help some of the private equity venture capital to look at IFSC and GIFT City in a much more robust manner.
Okay, there's a question for Gaura. This one is from Shukmani. Shukmani is asking the question. She says that we discussed the issue of we discussed the issue of rising tariff on China, and at the same time, the recent budget has reduced the basic custom duty on metals. Given this, how do you see the impact of potential dumping from China on India's domestic metal industry?
That risk is always there, especially right now, given the fact that China growth is slowing. They will tend to export deflations, so as to say, because they have excess capacity build up. That risk is always there, and it can be tackled with specific, I think, specific reform measures. But in general, what they have done of reducing custom duties on industrial inputs is important for boosting both domestic manufacturing as well as supporting our exports, because there is this the ask from the industry is that the pressure on input costs come down and we become a little more competitive, whether be it even within domestically as well as on the export stage. So that's what the budget is trying to do by giving some relief on the custom duty for industrial inputs specifically. But yes, that threat will remain.
Thanks, Gaura. One more question, Gaura, for you from Chandni. It talks about if Trump actually imposes tariffs on Indian exports, what would be the potential impact on India's economic growth? What policy measures India could adopt to mitigate the effects? And after that, there are many questions for Anant. I'll go. That's what for you, Gaura.
Good question. The good part for the India's growth model is we are domestic demand driven. We are more impacted by how consumption performs within our economy, domestic investment. We are a net on not just looking at US specifically, but overall we are a net importer. So the way net imports enter it, it's more of a drag on the growth. Not all the time, but most of the time it's a drag on the growth. So at the margin, a higher Trump tariff on India can potentially impact our exports, but the main driver for India growth is actually our consumption and as well as our domestic investments, because we are a domestic demand driven economy. So the impact will be, I would say, limited compared to, let's say, the impact that can be on an open economy such as China, which will really get badly affected by trade or trade tariff related measures. More important from our perspective is job creation. If you can create jobs domestically, that supports consumption, that supports demand, and in turn will give corporate sector that visibility that we are looking for, that they are looking for to, basically revive the private capex cycle. So there is a limited impact thanks to the fact that we are a domestic demand driven economy.
Thanks. We have 11 minutes left. I wish we could continue for long, but we can't. So quick questions for Anand and quick answer. Then we'll have our the concluding rounds. Anand, to Mr. Dr. Anand Nageshwaran, sir. Now, as with the new tax structure and updated rebates, almost 87% of the taxpayer from various the zero tax liability, considering the fact that the average income of Indians have increased over the years. How is the government addressing it? Will it be more? Will it have impact? Will it have the tax burden on the capital gains, etc., etc.? Essentially saying that will you square off this by putting the traders and investors under bigger tax net?
No, there is no need to assume what has not been said.
Okay.
The budget.
Okay. That's a that's a very quick answer. Now, Lavish's question is this: CA again the same thing with the onset of increasingly protectionist policies in the US and countervailing policies across the globe. How do you plan to strengthen our export-driven sectors like pharma?
I think multiple initiatives have been announced in the budget, specifically focusing on exports by removing procedural difficulties, and then the removal of inversion of duties and elimination of BCDs, basic customs duties on several items. And also the entire deregulation agenda and thrust is also about lowering the cost of production and cost of doing business, which will improve competitiveness. So the export thrust is not to be seen only in direct measures dealing with exports, but also in several indirect measures measures, such as, for example, as you pointed out, Tamal, the focus on toy manufacturing and labor-intensive sectors like footwear, textiles, etc. All of these together constitute the government's intervention on exports in a world where the overall global trade volume growth is going to be constrained. So it's about grabbing market share, which means the initiatives have to be in the form of investment in R&D and quality, and some of which have to happen in the private sector. Policy initiatives can only go thus far because export activity is actually undertaken by the private sector businesses. Back to you.
Thanks, Anand. I'll go back to you with a very interesting question. But before that, Abdullah, for you, from Yash, question is, in light of Trump comes back, recent decision to withdraw the United States from the OECD's Global Corporate Minimum Tax Agreement, how do you anticipate this move to affect India's tax policies and stance on international tax cooperation? Abdullah, please unmute yourself, sir.
Yeah, sorry. Okay. So, see, generally...
Fix 2 minutes, please.
Yeah, absolutely. We just go back a little in history. Looking at the DTAA models which were there, there was an OECD model, a UN model, and a US model. Okay. So as far as the global taxation is concerned, US generally has a totally different and a separate model that it follows. It has historically followed that. So the minimum tax, which is like sought to come in, US would like to prefer something else. So definitely it will not follow the OECD model.
Okay.
Because OECD model initially, just a few seconds.
Please, go ahead.
I mean, OECD model usually was for developing countries. UN model was for developed countries. And the US model was US model. So to that extent, I mean, considering I wouldn't have US follow the OECD model any which way. So I wouldn't say that's surprise. It is how they do it.
You are much in demand. One more question for you is this. Question to Mr. Abdullah. I think the same person Yash only asked because there is no sender's name here. So I presume it's from Yash. Yash Saxena. It said, given that a reduction in GST would have benefited a larger section of the population, whereas income tax reduction impacts relatively smaller segment, do you think the budget should have prioritized GST cuts over income tax relief? What are your views on this approach?
Well, I wouldn't say that would be a good idea. GST was supposed to be a single rate, single tax across India. 18%, I would say, is a reasonable rate. Across the board, trying to get down 18% any further to, let's say, a 15% or a 12% would have a huge impact on the revenue collection, which also, as far as the law is concerned, it's just 7 years old. It needs a little more time before, such drastic rate changes do occur.
A quick addendum to what Mr. Abdullah said. GST is a decision made in the GST Council. It cannot be announced by the union government.
Absolutely. I wanted to add that. Now, it's a very interesting, tricky question, and everybody, a lot of interest in that. This is the last question from the audience, and then we'll go back to conclude. This is for Chief Economic Advisor, Government of India, Ananta Nageswaran. The US is advancing crypto regulation through bills like the Financial Innovation and Technology Act, aiming to define SEC and CFTC roles and create a structural framework. In contrast, India relies on 30% taxation on gains, 1% TDS, and RBI oversight without a dedicated legal framework. Will India introduce a specific crypto law or continue with indirect regulation? How does the government plan to prevent Web3 startups from relocating to crypto-friendly jurisdiction while ensuring investor protection? Over to you, sir.
That's an easy one to answer because I don't know.
Yeah, there had been actually, I think, few years back, there was a crypto law about to be placed in parliament, and then RBI put its foot down. Everything happened. That's all in public domain. So we have 5 minutes left. So we'll have two very simple things. One is much talked about, but still maybe half a minute each. You can think that how serious is the Trump factor for Indian economy? All of us know that in February, Prime Minister would be visiting US. We need to wait for that. But as of now, I mean, we have seen what happened in US, his tariff war against three nations. But as far as India is concerned, how serious it is? Gaura, 30
So,
seconds or 1 minute.
definitely, it's one of our major trading partners. We have a goods surplus with the US. We have a services surplus with the US. Interestingly, our goods surplus with this US is larger than the services surplus. And during Trump 1.0, we did see some moderation in the merchandise surplus with the US. There was some moderation, but it didn't completely impact us extremely negatively. I think the good part of Trump 2.0 is I think it's going to be a little less aggressive. This is his second inning.
Gaura, I'm cutting you short. Yeah, you've said it. Yeah, Anil, Abdullah, anybody wants to say anything?
So
Just
very
two
quickly,
sentences each.
just one quick point. I think
Yeah.
India has enough avenues. The one avenue which I think we didn't hear is the global capability centers.
Okay.
And there's a huge amount of US GCCs already in India. So even if there are changes in tariffs, I think we've got enough for us to garner in terms of our trade share.
Abdullah, 30 seconds, sir. Anything you want to say?
Well, I would agree with Anil. Trump usually is more a business focused, I mean, politician rather than a typical politician. So wherever he sees business gains, he will do trading. India is a good business center. So like earlier, it didn't make much of a difference. So in a simple layman's term, I would say he's a businessman, he'll do business. India does business. So I don't think it should be much
Okay.
of an issue.
Let's hear the most important voice here. Anand,
No, I
Trump
think
effect.
in
Is it
India,
exaggerated fear?
India does have a few reciprocal offers to put on the table and be able to have a constructive dialogue, which will be a win-win. But it may not be appropriate to discuss them in public since the Prime Minister's visit to the US is on the table, is coming up soon. But it is not something that, as Gaura said, it is not something that we need to view with excessive concern in this country.
Good to hear, Anand. So my last question and probably 1-9 answer. I'll start with Abdullah. I'll go by this time is alphabetically. Abdullah, then Anand and all. So it's that what happened yesterday was the first act of the drama of this monetary fiscal dynamics. On 7th, MPC meeting gets over. Reserve Bank of India will announce its policy for the last policy for the current fiscal year. Now, since government has stuck to the fiscal consolidation path, would you expect RBI to cut interest rate, policy rate, I mean? Abdullah, just one line because that's the time.
Probably yes.
Probably yes. Anand?
I have no public view on this matter, Tamal. Back to you.
Okay. Gaura?
They'll have to cut as well as infuse liquidity. Liquidity is more important than the rate cut.
No, so you will be happy only for liquidity, no rate cut?
No, we would want both. Both are needed.
Okay. Anil?
I would stay there. I would think they would stay put and not disturb it at this point because we are in good shape.
Okay. Thank you, guys. We have just 45 seconds left. I have nothing much to say. We just had an interesting discussion, interactive discussion. I hope the audience enjoyed it and learned a few things like I have learned. Over to you, the organizers.
Thank you, sir. As we conclude this insightful discussion on the Union Budget 2025, Team Niveshak and the entire IIM Shillong community extends our heartfelt gratitude to our esteemed panelists and the moderator for their invaluable perspectives. We would also like to sincerely thank Professor Sharadnath Bhattacharya, our faculty mentor, for his guidance and unwavering support in making this event possible. Lastly, a special thanks to all the students for their active participation, which enriched the discussion. Thank you for making this session meaningful and impactful. We hope you leave with a valuable takeaways from today's discussion. We would request now to all the students to log off and the panelists